10-minute delivery has transformed the Indian urban landscape, promising everything from groceries to electronics at the tap of a button. Venture capital firms fueled this expansion with billions of dollars, prioritizing rapid user adoption and logistical speed over immediate profitability. Deepinder Goyal, the founder of Zomato and its quick commerce arm Blinkit, recently shattered the industry's facade of stability by launching a direct attack on his rival, Zepto. Goyal claimed the quick commerce sector was burning 5,000 crore rupees every quarter and alleged that Zepto accounted for more than half of that total. Zepto's co-founder, Aadit Palicha, publicly rejected the claim as verifiably untrue, promising that formal financial disclosures would eventually settle the matter. This public friction signals a deep structural tension inside the industry. Founders in the Indian startup ecosystem rarely target each other's financial credibility unless the competition has reached a breaking point. Zepto's 2025 fiscal year filings provide the necessary evidence to evaluate the claims made during that public exchange. This line chart shows Zepto's annual net loss, which climbed from 1,215 crore rupees in 2024 to over 3,367 crore in 2025. This 177% jump means Goyal overreached on the quarterly figure, but his warning about the financial trajectory remains real. The green line shows total sales nearly doubled to 9,669 crore rupees. Even with massive scale, losses are expanding faster than revenue, intensifying financial vulnerability. These losses are driven by the high costs of maintaining a network of dark stores, ensuring continuous rider availability, and managing high-frequency order density across dense urban clusters. Scaling the quick commerce model currently requires massive, ongoing capital injections rather than producing operational stability. Goyal's decision to single out Zepto's losses functioned as a calculated boardroom maneuver intended to shift investor sentiment. Goyal wants to position Blinkit as the disciplined, efficient operator. In an environment where investors increasingly care about margins, framing a rival as reckless helps Blinkit secure its own strategic standing. Palicha had to push back immediately to protect Zepto's reputation. Allowing a competitor to define your company's financial health could be catastrophic when managing investor relations or preparing for an IPO. In sectors where actual profits are deferred to the future, management teams use perception as a competitive tool to bridge the gap between current losses and future valuations. This was a battle for narrative control. Both founders were attempting to define the quick commerce story before the next phase of consolidation and fundraising. The primary catalyst driving this public feud is the impending transition from private funding to an initial public offering, or IPO. Venture capital firms have subsidized these delivery wars for years. An IPO represents their primary mechanism to exit their positions and secure their returns. This flow diagram shows how an IPO shifts risk. Private investors sell their shares, moving the financial burden to everyday retail investors. Retail investors may buy into a growth story exactly when private backers reduce exposure to widening losses. Before participating in any quick commerce IPO, look for evidence that losses narrow as scale rises, and verify that management's public claims align consistently with their formal financial disclosures. Product popularity can easily mask financial fragility. Without a clear path to durable economics, the everyday investor is the one left holding the bag when the external funding finally stops.